Hello, YouTube. If you've been wondering whether or not it's been a tough year so far, that is correct. The reason why is because history is repeating. And right now, as we look here at the 12-month chart or the annual chart for the S&P 500, we have a bearish engulfing candle, which means that we printed a higher high and we printed a lower low. And this is not good because as history tells us that the S&P 500 hasn't had such a bad first half since the Nixon era. US benchmark index is set for the worst first half since the 1970s. This is not good at all. Richard Nixon was president. We removed the gold standard, and a lot of stuff happened in the 1970s. So we are now having our worst start to the year in 50 years. And the big question is, do we actually have clarity on where we're going to go from here? I'm not sure we do because Jerome Powell was speaking today with Christine Lagarde from the ECB and Governor Bailey from the BOE. And this is what the headline that stuck out to me was. We understand better how little we understand inflation. With all due respect, Jerome, you have a dual mandate, price stability or inflation and full employment. If you don't understand inflation as the head of the Fed, who does? This seems a little bit hopeless. The other thing I would note is Powell, right? Pre-pandemic world low inflation gone for time being. However, what they have not yet done is actually raise their Fed fund futures to a level that is higher than where we are right now. And what I mean by that is the 2-year note and the 10-year note. They're both down to about 3.5 and 3.9%. Looks like we might even invert again sometime soon. The reason why this is important for me is because as we look to what the market is discounting, what we're looking to do is get to roughly 2.5 to 3% by the end of the year, and then 3.5 to 4% by next year. But it still seems a little bit too optimistic when we listen to the words of the Fed chair, right? Pre-lockdown world, low inflation gone for the time being. Oh, but by the way, I don't really understand what inflation is. This is, again, this should be a humbling experience for the Fed because the ECB went first explaining that the oil shock and bottleneck constraints meant that we lost control of the narrative. And when I read this and this other headline here, I'm thinking, man, I'm not fighting this guy. He's saying, I don't care. I'm on a sole mission to destroy inflation by any means necessary. And since we're all the way back to the 1970s on, the expectation that we can trust the Fed and what they say, well, now the market's starting to discount that a little bit, myself included. So as we look forward to the rest of the news that we have here, this was also very notable that I looked at yesterday. So it's not just me saying that we don't trust the Fed. People are selling. So as we note here, going back to January, or again, since the worst period starting since the 1970s, in January, we saw $5.5 billion in inflows when we legged up. In March, we saw $42 billion in inflows. In May, we saw $30 billion. And then in June, we actually saw outflows of $10 billion, which meant that people were shorting the rip, right? Fade the rally. That's what was happening. And this is not a very good predictor for the future when people are only now starting to lock in those losses because we've been talking about how we have that $1.1 trillion that's been fed into the market since the beginning of the year, and their average cost on that is about 428. So if we keep that in mind at 428, yeah, no one's making money. But now we're starting to finally see some of these guys actually fold. And since they're folding here, are they going to keep folding? Are they going to sell into the weakness? I don't know. But man, this does not look good at all. So keeping in mind that we're now looking at history, I want to zoom out here for one more second and remind us that tomorrow is going to be the end of the quarter, and we also have a bonus OPEX, which means that every day, today all the way through Friday, we have an expiry every day, 4 out of 5 days. Last week, it was 3 out of 4. I am recording the video for the end of the quarter today because I am moving tomorrow, and I'm not confident I'll be able to get a video out. So I'm trying to anticipate what I think is going to happen tomorrow and talk about it. We'll note here that we have 3 notes in the middle. They're all bolded and underlined, which means that these are the big catalysts for the week. Tomorrow, we're likely going to have a big move or a whole bunch of nothing. And I'll talk about that when we look at the options. On Friday, if you're going to hold overnight, please be mindful that we got European CPI and ISM manufacturing coming out on Friday. European CPI is going to be coming out pre-market and ISM shortly after the open. I am aiming to have a Friday stream as well, but no guarantees just because I don't want to overcommit. So what I want to look at now, since we're also closing out the end of the month, is whether or not we are on track or if we're deviating from our psychology chart here, where it's been pretty accurate up until now. But We were supposed to be at about 400 if we're not going to invalidate this pattern. Oh boy, we're not at 400. When I last took the screenshot here, we were at 365. We are a little bit higher now, but man, we have so much work to do to get back up to 400. We're barely able to hold on to last month's low, 380.54. We closed below it, and after hours, we're also below it. So everything tells me that even if history is repeating, when we saw those outflows coming in, yeah, they're not waiting for the bounce to actually fade. Sorry, to sell out. They're actually getting out a lot sooner than I would have anticipated. So when we're making history for 50 plus years, and our psychology chart is not even reliable, we have to ask ourselves whether or not there is some undertone to the market that we don't see at the surface. I think there is. So for me personally, if we close below the 380.54 low tomorrow, it's going to be resistance. If we close above it, it should be support. But we have a massive mountain here. And honestly, I don't like this at all. The reason why is because if we look back here to our monthly chart, what we're going to notice that the volume's actually, again, let's look at the volume here. So last year we put in about 18.5 billion shares traded. So far this year, 13. So 13.2 times 2, because we're closing out the end of the first half of the year, that would be 26.4 billion. And compared to last year, 26.4 divided by 18.5, we're looking at about 42% more volume this year projected than last year. Why would that matter? Well, red price action with red volume means what? It means we're probably going to go lower. The price is pointing down and volume is confirming as of right now. So this is how an unwind happens and how a recession can turn into a deep recession, if not a depression. The Fed right now seems like they are hell-bent on making sure inflation goes down. But a lot of market participants, myself included, don't just have fears about inflation or recession. Now we have to also worry about growth concerns because the Fed is tightening at any means necessary, right? It doesn't matter what's going to happen. We're tightening. So that's the landscape we're in right now. If we now look forward to, I actually lost my lines. I'm going to have to draw them again. But anyways, we're going to look here at the daily chart because this is going to be better for us to look at than the weekly chart. So what we can note is that today we filled the hole. We filled the gap down to 378.9 and 378.83, my apologies. And we bounced off. We had a low of 378.42. So this gap is now filled and we got 3 left up here to 402. This gap is now actually technically filled as well. I'm going to delete that one. And now we have the lower one. So the question is going to be, if we're going to be looking at that monthly, and again, on the monthly here, if we are below the 380.54, it's probably going to be resistance. We're probably going to go to fill that lower gap. If we are above 380.54, we might be able to move higher to fill that upper gap. All bets are off if we start to go the opposite way, though. So looking here, what I am trying to do is to understand the price action, not tell the chart what's happening, but understand what's happening. So Jerome gave us a pretty nasty headline today. George also said that, I think it was Master George. She also mentioned that I'm supportive of 75 in July. And the Fed has not even reduced their GDP outlook for the year, which means we have to grow at 4.3 for the second half of the year to maintain their target. So July could also be when they're going to be revising their growth outlook and hiking higher than people might like. So in terms of tomorrow, because we're looking for either above or below 380.54, with our gap now filled, I would really want to see us, again, form a higher low tomorrow. Why? Again, upper wick here, we were going up for multiple sessions, almost back to back. The one bullish engulfing is the lower low, but we engulfed it. Low, higher low, higher low, higher low, higher low, higher high, higher high, higher high. Now what do we have? Bearish engulfing, and we got a lower high and lower low. So if the bulls are going to maintain this 380.54 low going back to May, we have to close above 380.54, which means that tomorrow we cannot print a daily lower low. This buying here into the close cannot get hurt. It needs to get back up. And on the flip side, if we cannot break the higher high and we print an inside bar, the price action on Friday is going to be the most telling. Last thing I'll note is that post-OPEX with the 3.2 trillion in notional value expiring, what did we do? Well, we got a little bit of an opposite move, and there is the true move down. So it's not looking good at all. Anyways, at least now we understand what's happening. So whether or not we're happy with the price action is different than whether or not we understand what's being told. going to take 2 minutes here to explain what's happening on the chart as well, because closing at 380, I was noticing that we weren't really moving at all today. Why? Again, where's Max Pain? Well, splitting the calls and the puts, it's roughly 380 to 381. So no surprise, that's where we close. They burnt everything here, right? All these are burnt. Everything here is burnt. And that's a lot of premium for them to be playing with. The reason why this is important is because we have an expiry every day this week. So as I look forward to tomorrow, where there is a lot of open interest, this is going to be particularly important because, again, we're now going to close this one out. Here we're looking at June 30th, or the last calendar day of the month in the quarter for the 16s. And here we're looking at that same area, right? 380. So 380 is kind of the line in the sand where there is a lot of open interest and volume. These guys are not closing out. They want to hold all the way through to expiry. So we have to be where? 377 basically for them to get their money back. What would that mean? That would mean a daily lower low. We went down to 378.4 today. So if these guys want their money back at 380, we have to print that daily lower low. We have to close below it, in fact. So that is not looking good. We have volume all the way down to 375 and even lower. In terms of calls, 385 up to 400, but the bull case for us to get to 400 is seeming a lot less likely. So because today Max Pain was roughly 380 and we closed at 380, I think that if we close at 380 tomorrow or get a whole bunch of nothing, the option sellers are in control, not the option buyers, which means they want to burn everything. And if now we understand the motivation going into tomorrow in the end of the quarter, but also that where we close in terms of price really matters. If we look forward to Friday, then finally over to the July expiry, we'll see whether or not they're just bullish going into Friday or if they're bullish beyond that. So here's what I'm noticing is 385 and 380. Same spread for the calls. On the put side, what do we have? 380 with volume and open interest, same thing as the calls, down to 375, which for me means that 380 is going to be Max Pain all the way through to Friday. Who takes control of the chart, who tries to get paid, is going to really make a big difference for me. Option sellers, are they in control? If we are, should be a whole bunch of nothing between now and Friday. If option buyers are in control, I'll be watching for an explosive move up to fill the upper gap or explosive move down to fill the lower gap. I honestly don't know which side has the edge. But the bears are definitely flexing again. Bulls had a 1, and now they appear like they are done. Looking forward to July. We want to see if there's motivation for anyone to buy anything beyond just where we are today. Yep, it's just not calls. I know because I checked this on the weekend. So 385, 380, 375, right? There's continuation. There's also more volume today than on the call side. All we have for calls are going to be 380. And it's personally hard for me to tell whether this is a straddle with a 380 put or if they are actually building a spread. I honestly don't know. So if you're interested in learning more about how we got prepared for this week, I encourage you to watch the video that'll queue up here at the end of the video. Otherwise, I wish all you great people a terrific end to the first half of the year, the end of the quarter, and I very much look forward to seeing you on Friday. Thank you for tuning in, and wish you all the best of luck.